Ever since Wednesday, when the Federal Reserve released the minutes of its December meeting, Bitcoin and other cryptocurrencies have been on a free fall. While we didn't exactly know what would be in this report, we had an idea about the rising inflation and the Fed's plans to start tightening its monetary policy. Nonetheless, the report still scared investors badly. Bitcoin fell to slightly below $40,000 and Ethereum came terribly close to the $3,000 mark. So the question is, what was in this report that scared investors so much, and why is Bitcoin crashing despite the ever-rising inflation numbers? Welcome to Cent Essential, and let's get right into it. In December, we received news about inflation reaching its highest level in over 30 years, and so when the Federal Reserve had its meeting on December 14th and 15th, investors expected them to take all measures possible to curb the rising inflation. What investors did not expect, though, was the Federal Reserve to disclose that inflation would last way longer than they had anticipated, and that they would take even more aggressive measures to control it. Now that the Fed has told us inflation will be lingering for a long time, the pressing question is, why is Bitcoin crashing? Isn't Bitcoin supposed to be a hedge against inflation? Here are 3 reasons why. 1. Rising interest rates make safer assets more lucrative to investors. To understand the effect of rising interest rates on Bitcoin, we first have to understand the effect of these rising interest rates on treasury bonds. I know bonds are boring, but they highly affect the broader market, so please try to stay with me for a moment here. The government uses treasury bonds to borrow money from individuals and institutions, and in return, the government pays interest based on a market interest rate, also known as bond yield. So, for example, by buying a 10-year treasury bond, you could lend the government, say, $10,000. The government then promises to pay you a 1.7% interest rate every year for the next 10 years. This means that you'll receive a bond coupon of $170 every year. It might sound like a small amount, but when big institutions buy bonds worth billions, then the returns add up big time. What makes treasury bonds special is that they are some of the safest investment assets out there. As far as investment safety goes, it doesn't get any safer than lending money to the government of the United States, one of the most stable economies in the world, and getting paid interest for a couple of years, then getting your money back after the lending period is over, for example, 10 years. So when the Fed raises interest rates, the interest paid on treasury bonds also rises, which means you get more interest on the same amount of money loaned to the government. And so, treasury bonds become more attractive than other investments for 2 reasons. 1, then they now offer better returns, and 2, they guarantee safety, unlike investments such as Bitcoin, which are extremely risky and could lose more than 50% of their value in just a few days. At this point, investors ask themselves a simple question. Would I rather put my money in a safe investment that guarantees a higher interest, or do I put my money in a risky asset which nobody knows whether it will perform well in this economy? This is when investors begin to trade their high-risk crypto for safer options like treasury bonds, and Bitcoin starts to slowly fall. The second reason why Bitcoin is crashing is the strict contractionary measures that the Fed announced in its report last Wednesday. Indeed, there is high inflation, which is expected to last a long time, and we know Bitcoin should thrive during inflationary periods, but why is it crashing instead? Well, one of the possible reasons is the Fed's announcement that it will be taking more rigorous contractionary measures to correct inflation. So instead of continuing to print money, which raises inflation and makes Bitcoin go up, the Fed has announced that it will end its bond purchasing program sooner and start raising interest rates by March this year. If that's not contractionary enough, the Fed also plans to start selling the assets on its balance sheet shortly after the bond purchasing program is over. But what does it mean by the Fed selling its assets, and why is it an aggressive measure? This might sound a bit complicated, but I'll try to break it down further. Let's roll it back a bit to when the pandemic hit in 2020. There were fears that the economy would slow down, shrinking the GDP and causing massive job losses, just like what happened during the Depression of 1929. So in response, the government passed policies that would provide stimulus relief to individuals and distressed businesses. Additionally, the Federal Reserve took its own monetary stimulus measures. We've all heard the infamous statement, "The Fed is printing and pumping money into the economy." But how do they do it? When the Fed supposedly prints money and pumps it into the economy, they do it by buying assets such as bonds and mortgage-backed securities from banks, institutions, and distressed companies. This way, they lend money to them and make cash readily available to businesses so that they don't go bankrupt. Meanwhile, the more the Fed buys these assets, the more its balance sheet grows, and right now it has about $8.7 trillion in its balance sheet. So the Fed is now planning to sell these assets. Now, it's normal for the Fed to sell the assets on its balance sheet, but what makes this a harsh contractionary measure is the fact that the Fed will be selling them shortly after the bond buying program ends. In the past, the Fed has waited about 2 years after a monetary stimulus ends before it starts offloading these assets. But what's the problem with the Fed selling its assets, you may ask? Well, an increased supply of treasury bonds in the market will push prices downwards, causing bond yields to rise, and in result, what we discussed in the first point, which is making safe investments like treasury bonds more attractive to investors by offering them an even better interest rate. I hope I didn't lose you there, but here's a more straightforward explanation. When the Fed floods the market with bonds, the following will happen. 1. The price of bonds will fall. 2. Bond yields will consequently rise. 3. It will attract more investors. 4. Investors will dump risky assets like Bitcoin and will go for bonds. The third reason why Bitcoin is crashing is because of a strengthening dollar. Data collected over the period Bitcoin has been around shows that sometimes the value of Bitcoin is inversely proportional to a strengthening dollar, which means that when the value of the dollar goes up, the value of Bitcoin goes down. Of course, this is not always the case, but it has happened many times. And remember the 2 actions the Fed will be taking to reduce inflation, that is 1, increasing interest rates, and 2, selling off assets on its balance sheet? Well, these 2 actions actually strengthen the dollar, and as a result, the dollar becomes a haven for investors worldwide, especially those from countries with weaker currencies who prefer to park their money in a high-yielding currency that guarantees their returns and protects the value of their money more than a high-risk asset like Bitcoin would. I hope this helped you understand why Bitcoin is crashing despite rising inflation. Over to you now. Are you a crypto investor? Let me know in the comments how you plan to invest in 2022. Also, grab up to $250 worth of Bitcoin when you sign up to BlockFi using the link in the description below. If you liked this video, go ahead and give it a thumbs up and consider subscribing as I'll be posting more videos in the coming weeks. Thanks so much for watching and see you again soon.